What's up, everybody, and welcome to Heresy Financial. This is the channel where we talk about financial topics in a way that is considered heresy to the financial establishment. I'm going to bring you the news that you're not hearing anywhere else and break it down for you in a way that is easy to understand so that you can take action on things that will actually help you financially. Today we're diving into the scary topic of the shadow banking system. And if you follow financial news at all, you might have been hearing more and more about this lately and the threat that it might pose to the entire financial system. Today we're going to break it down, see if it actually poses a threat, and if so, what threats does it pose, how does it work, what is it, and what can you do about it yourself. Let's dive in. All right, guys, the first thing that we need to cover in regard to the shadow banking system is the name itself. And the name conjures up images of illegal back alley activity, things that happen, through money laundering or other avenues. And that is just not the case. The term shadow banking system refers to any institutional activity that takes place that is considered a banking-like activity, but is not performed by an actual bank. A great example of this is Quicken Loans. Quicken Loans is not a bank, but they offer mortgages. Therefore, they fall under the category of shadow banking because they perform bank-like activities like mortgages, but they are not actually a bank. Now, by law, in terms of the legal definitions of things, if you are a bank, you are an institution that accepts depositors' money and then uses that money to make loans. That is what a bank is. But Quicken Loans does not use depositors' money for loans. They just use their own money. They don't have a bank where they accept deposits that depositors that need checking accounts or savings account can give Quicken Loans their money. Another great example of something that would fall under the shadow banking system definition would be an ETF, an exchange traded fund that invests in bonds. So ETFs that invest in things other than stocks are a lot of times considered to be part of the shadow banking because they're taking part in the financial industry that is comprised of debt and deposits and leverage, but they're not actually a bank because they don't have real classic traditional by law definition checking and savings accounts. Okay, so now that we have that out of the way, that the shadow banking system is nothing illegal, it's nothing intrinsically scary, we're going to look at all the types of companies and practices that are included in the shadow banking system that people are saying is causing a threat to the financial system right now, and then we're going to look at what can actually be done about it. But in order to do this, we do have to take a little bit of a detour, a little bit of a history lesson, and go back all the way to goldsmiths. Because goldsmiths, believe it or not, were the precursors to banks. You see, when gold was money, people would realize soon that once they started accumulating enough gold or silver, they wouldn't really want to hang on to it all themselves. So they would go to the goldsmith, who just naturally would have high security because they're dealing with a lot of very valuable material. And they would go to the goldsmith and they would say, hey, hang on to my gold for me. And in order to make sure that I can come back and get my gold whenever I want, I need you to give me a receipt. And that receipt will show that it's, that amount of gold is my gold, and I can come back here and give you the receipt whenever I want, and I can get my gold back. And the goldsmith would, they do this for maybe a small fee, and then they would hang on to the gold and they would store it securely. Well, after a while, goldsmiths caught on and they thought, you know what? I have all this gold in my vault. I can do something with it to make even more money. So I'm going to loan a little bit of it out and charge interest on it. So when somebody would need money for, let's say a building project or an investment or a business, they would loan them gold and charge them an interest rate on it. Depositors of gold to the goldsmiths at first didn't realize that the goldsmiths were loaning out their money. They thought the goldsmiths were loaning out money that belonged to the goldsmith. They didn't realize that they were loaning out deposits that they had lent them for safekeeping. And so once people caught on and realized this was happening, you had the first run on the bank where people went and said, give me all my gold right now. Well, the problem is you have short-term obligations funding long-term liabilities. And what that means is that you've just loaned money that you're expecting to get back in maybe 5 years or 10 years, but the money that you loaned out, now you owe it to somebody who expects it back now. because you use deposits that could be withdrawn at any time. That's a short-term obligation. and you use that in order to fund a long-term liability, meaning I'm not expecting to get that back for 5 to 10 years. And so that's called a maturity transformation, when you take short-term funds and use it for a long-term investment, because that short-term fund can be called at any time, whereas you can't call what you just loaned out at any time. You're not expecting to get that back for 5 to 10 years. So all of a sudden you had all these people going to get their gold back, and as you can imagine, it was not a happy time because there was not enough gold for everybody. You would think that after a practice like this became well known, that it would have been illegal. It seems like it would be fairly rational for the powers that be to say a practice like this should be illegal, and that if you make a contract with somebody, that you should be able to fulfill that if they want that contract to be fulfilled. Meaning, if I give you $1,000 and the contract says I can come back and get it from you at any time, you better be able to fulfill that contract legally. Well, this practice didn't actually die off, as you might imagine. It became practiced among many banks. And you can go back and look at up to 12 to 1500 years worth of financial documents and history and see that practices like this were fairly common and virtually always led to a crisis, where eventually people would realize there wasn't enough money if they all went to try and get their money, so then everybody would try and go get their money and there wouldn't be enough and the bank would close. Classic run on the bank. Well, after this happened a number of times, you had the governments realize, hey, we need to do something about this. But again, instead of making it illegal, what they did was they nationalized the practice. And they said, well, now we're just going to have something called a central bank. And that's a bank sponsored by the government that is going to do the exact same thing as everybody else. But this time, since it's the government doing it, it's legal. This was the creation of the Federal Reserve. Before the Federal Reserve, you just had isolated banks that may or may not shut down depending on their practices. You had a lot of banks that performed and practiced according to high standards and kept the amount of deposits needed in order to let depositors redeem their deposits when they wanted. Well, the Federal Reserve Bank came in and said, we are going to make sure that all banks have the exact same amount of reserves. Now, the reason for this was because there were certain banks that realized I can have a higher profit if I loan more of my deposits out. But if there are other banks that are keeping those deposits and not loaning out the same amount, then eventually my reserves are going to get drained and just go to them. So they wanted to make sure all banks were abiding by the same practices and only holding a specific amount in reserves. So they formed the Federal Reserve to make sure that all banks were abiding by the same practices of only keeping a certain amount in reserves to make sure that one bank wouldn't absorb all of the reserves from another bank. Well, as you can imagine, this didn't turn out too well either, because after the creation of the Federal Reserve in 1913, it only took 16 years to lead to the world's greatest financial crisis, known as the Great Depression. Instead of realizing their mistakes, they increased their mistakes. They took a system, like I've said before, that was anti-fragile, in the words of Nassim Taleb, where you have a decentralized system where each individual part is fragile. And eventually, a fragile part will die because people will realize it's not worth it or it's not honest, and they'll take all their money out and that bank will collapse. And all the other banks that were strong will get stronger. And in that way, you have an entire system built on very strong individual nodes. And so you turn an entire system that was anti-fragile before and make it fragile, because now there's no risk at the individual node level, the individual bank level. All the risk has been transferred to the entire system itself. Okay, but we're getting too far ahead. Let's go back to the Great Depression. The Great Depression eventually led to World War II, and after World War II, much of Europe was in shambles and they didn't have any money because war is a destructive force. And like I've talked about before, wealth is not a zero-sum game. Wealth can both be created and destroyed. And war is a negative-sum game, therefore it destroys things, it does not create things. And so most of the wealth in Europe was actually destroyed. It wasn't transferred, it wasn't grown, it was destroyed by war. And so instead of rebuilding, Europe said, hey, America has money, so instead of rebuilding, we're going to just rest on America. Prior to the Great Depression and prior to this moment after World War II, the entire world was on a gold standard. A gold standard didn't mean that the price of gold was fixed to your currency. It meant gold was actually money. Now what that means is that in America, gold was money, and then I could go and take gold to any country on earth and use gold as money. The only difference was how much gold was actually in the coin that was minted by any given government. There was no exchange rate, there was no currency exchange needed because gold was actually money. Well, no longer, because Bretton Woods was put into place after World War II, and that meant the world wasn't on a gold standard anymore, and each individual country had their currency pegged to the dollar now instead of pegged to gold. Now, everybody thought this was okay because the United States still had a lot of gold and the dollar was backed up by gold. And when I say backed up, I mean redeemable in gold. That's the only way something can actually be backed up by something, is if it's redeemable. So you could take a US dollar and give it to the Federal Reserve and they would give you that amount in gold. Well, remember what I said earlier about the fractional reserve system and how a bank will take your deposits and they'll loan some of that out? Again, they're not loaning their own money, just like the goldsmiths weren't loaning out their own money. They're loaning out your money that you deposited. Well, the United States did the exact same thing, and they started creating a lot more dollars than they actually had gold to back up. Well, the world soon wised up to this, and the world said, hey, give us our gold. Take these dollars back and give us our gold like you promised since the Bretton Woods Agreement after World War II. Well, obviously there was not enough gold in the system to redeem everybody's dollars, and so Nixon shut the gold window, otherwise America would have been drained of all their gold because they created too many dollars for how much gold they actually had. So they effectively stole the wealth from the world at that point. Well, this, as you might imagine, led to rampant inflation. So prices rose and the amount of fake money in the system continued to expand. Well, in 1980, the Federal Reserve decided enough was enough and they changed the way that inflation was measured. That's right. Instead of changing the system, let's just change the way we measure it. And the CPI, which is the Consumer Price Index, the formula for how prices are measured, was actually changed in 1980. And guess what got under control in the 1980s? That's right, inflation. Almost like it was a magic fix. Well, fast forward to the 90s, and you have some crises happening around the world, especially in Japan. And so the Federal Reserve decides, hey, in order to get in front of this and make sure we're not affected by this, we're going to lower rates and make money a little bit easier here in the States. One thing the Federal Reserve is really bad at predicting is second order effects, and that's simply unforeseen consequences of actions. You try and fix something over here and you end up breaking something over here. Well, one result of making money really easy in the 90s was that money flooded into these new tech companies and caused a massive bubble in internet-based companies. Well, once everybody realized it was a bubble and prices started to collapse and started to take the stock market out with it, the Federal Reserve said, hey, I know we caused this problem by creating money out of thin air and making it really easy for debt to happen and causing a bunch of cheap money to flood the system. But instead of changing course and making sure this doesn't happen again, let's go further down this path and drop rates all the way down to an unprecedented 1%. And again, this was in 2001 when the bubble started to collapse. Especially after 9/11 happened, they dropped rates down to 1% in order to stimulate the economy again so that it wouldn't make things too painful for the average American. Well, where did all that cheap money go? As you might remember, it went into real estate. Now, this was the first time in American history where there had been a recession and housing prices didn't go down. Because the recession prompted that 1% in rates by the Federal Reserve, and all that new easy money went into real estate and kept the real estate market from going down and made it continue to go up. And so all of a sudden now you have investors saying, hey, even in the midst of a recession, housing goes up. That means housing is recession proof. It's a safe investment. It's recession proof, and it caused a massive amount of money to start going into real estate. Now I'm going to pause here on the history lesson because this is a classic example of malinvestment. Now, malinvestment is a case where you have an investment in something over what it's worth. As a society, you pour money into something and it's really not worth all the money that goes into it. Eventually, the free market will realize what happened and it'll correct for that and the prices will collapse and they'll come down. That's a classic recession. A recession is a rebalancing of the economy. A recession is fixing that malinvestment. But the problem is the Federal Reserve didn't want that pain to happen. After that first recession from the dot-com bubble burst, they made rates go down even further, which caused a bunch of new money to go into housing. Well, everybody knows how that story ended. The financial crisis. But what most people don't realize is what part the shadow banking system played in this collapse. And again, I want you to remember that the shadow banking system is nothing illegal. It's not money laundering. It's not the mafia. It's these normal companies out there that are just outside of the traditional bank. They don't accept deposits and loan that out like a fractional reserve bank does. These are institutions that engage in banking-like behaviors, like giving out mortgages, but they're not classic banks. And so you have all of this easy money going into housing, causing a massive bubble that people don't realize is a bubble. You have all of these profits to be taken in one area of the economy. You're going to have a lot of business activity flood that direction. You have mortgage companies popping up that are offering adjustable rate mortgages. And I don't want you to think that this is a case of bad businesses taking advantage of people, because Alan Greenspan at the Fed actually said and encouraged people to take out adjustable rate mortgages. The Fed did this. Okay, now you all know that story. There were a lot of adjustable rate mortgages, and then those mortgages were packaged up into these giant investment vehicles, and then those investment vehicles were sliced up and offered to investors. And that's just a fancy way of describing how any fund actually works, because when you buy a mutual fund, what that mutual fund is doing is they're buying up a bunch of stocks, they're packaging up those stocks together, and then they're slicing up that mutual fund into investable chunks, and you give them $1,000 or $10,000, and then your $10,000 is distributed among all of the investments inside of it. That's all they were doing with mortgages, because who expected that this area of the economy that was booming, that was backed up by people just living in their houses like they had always lived in, would have so much malinvestment? Nobody. And so all these mortgages were taken, they were packaged up together, sliced up, and then offered to investors. Now, in order to accomplish that, you have to have a lot of businesses at play. You have to have the actual companies creating the mortgages. You have to have the market of investors and retirement accounts and mutual funds that are buying up those mortgages. You have to have underwriters. There are a lot of businesses at play in this system. Now, there were some companies and some executives and some people that did know the moral hazard of all of this. And they hold a ton of responsibility for this, but not as much as the Fed. Because these people that were high up and deep in the system and knew what was actually happening and knew the danger it caused to the system, they also knew that the Federal Reserve had an implicit guarantee on these things and would bail everybody out in the end. So there was no reason to stop the practice, because I'm making profits on it now, and when it all starts to collapse, the government's going to save us. And they knew it. But again, the buck stops with the Federal Reserve on this issue, because if they didn't have that implicit guarantee and that bailout waiting to happen, the moral hazard wouldn't have been there. And they all knew the system was so fragile that if there wasn't a guarantee to bail it out, then the entire system might collapse. So we know how that ended, and we all think that there were some more regulations put in place to prevent this sort of thing from happening again. But what I want you to understand is that the term shadow banking system was actually coined in 2007. And the Federal Reserve and the International Monetary Fund and other elite economists have been pushing this term to expose people to this idea that there are illegal or unregulated dangerous activities taking place out there that need to fall under the regulations of banks and need to fall under the control of the Federal Reserve, just like real banks are. But like I said, most of these companies and most of these practices are doing nothing out of the ordinary. In fact, they're engaging in normal market behaviors. When there are profits to be taken, new companies will enter until those profits are not worth it anymore. And again, here's why the Federal Reserve is at fault for this, because by making interest rates so low and keeping them so low, you artificially inflate a specific area of the economy. And some of these second and third order effects that you can't predict are things like bubbles. And without top-down control and centralized interference, you would have malinvestments fixed by recessions. And you would have bubbles fixed by collapses. But when you have implicit guarantees and bailouts, the cure is no longer allowed to work. And so the Federal Reserve, in all their wisdom, they think that the reason that these bad things happen is because they can't control everything. Right now, they're only controlling banks. And they say, oh, well, if we could only control everybody outside of banks as well, then it would be a utopia. And they don't realize that it's their very control over the banks that are prompting these malinvestments in the first place. The shadow banking system, here's what it looks like today. It's not as much mortgage-backed securities, but it is debt-backed securities. And this debt is backed by, yes, mortgages, but also auto loans and student loans and primarily corporate loans. Now, this is where it gets dangerous, because these corporate loans, a lot of them are made to companies that are not creditworthy. But because interest rates have been kept so artificially low, the debt is offered at extremely attractive rates. Now, this debt isn't offered to you and me through things like credit cards because people who need a lot of debt on credit cards are not exactly credit worthy. If you need to fund most of your living expenses through credit cards, the credit card company is going to want a very high rate of interest in order to compensate themselves for the risk that you might not pay it back. But in the interest of stimulating the economy, the Federal Reserve is keeping rates so low that companies that are not creditworthy are getting debt at a rate that is very favorable, far lower than what the market would want to set by itself without manipulation. And what they're doing with this debt is stock buybacks, and they're inflating their stock prices to make it look like they're doing a great job with their company. And this is primarily what's been driving the stock market rise over the last 10 years is stock buybacks. The overwhelming majority of these stock buybacks are financed by cheap debt. Now, we hear about companies that are big doing this, companies like Amazon or Berkshire Hathaway or Apple doing this, but it is a very widespread problem, and most companies are doing this. And the biggest reason why this is a problem is because it can't go on forever. At some point, the debt is going to be maxed out and the growth is going to be maxed out and it's going to start to reverse. And when it starts to reverse, they won't be able to take out any debt to fund their daily obligations. And when you need debt to fund your daily obligations and you're also using that to inflate your stock price, when that turns around, the only thing you can do is sell your stock. And if the majority of the stock price rising over the last 10 years has been due to stock buybacks, well, when that stock starts to get sold in order to pay off that debt, you're going to have massive drops in the stock market. Now let's trace this back. Most of this money comes from money market funds through the repo market. Now, money market funds, like I've talked about in previous videos, money market funds are where cash is held in all investment accounts. So if you have a pension, if you have a 401k, if you have an IRA, if you have a brokerage account, any cash that's in those types of accounts are held in money market funds. Needless to say, this is an insane amount of cash. And that money market fund will pay you, the investor, a tiny amount of interest. Some of the best ones out there pay 1% to 2% right now. What that money market fund does with your cash is they go to the repo market, the repurchase market. And if you haven't watched my previous video on the repo market, I'm not going to cover the details in it right now because I made a whole video about it. You can go back and watch that video. But they loan this money out through the repo market, and in return for the cash that they're loaning out, they get a security to hold as collateral. Now, a lot of times it's treasuries that are offered as collateral. But with the size of the market right now, treasuries probably are not the biggest source of collateral. A bigger source of collateral in the repo market right now is probably things like collateralized loan obligations, again from these companies that offer loans to other companies that are doing stock buybacks, and things like packaged up auto loans and student loans and credit card debt. And yes, as well, mortgages. And so these packaged up debt instruments are being offered as collateral for regular dollars in the repo market. Well, it would seem that there are certain lenders in the repo market right now, especially big ones, that are catching on and realizing, hey, a lot of this debt probably isn't very good right now. And especially when the recession really starts to kick into gear and the stock market might start to turn around and reverse the gains that have been ticking up the last 10 years, we're going to see these debt instruments start to fail miserably. And so institutions who have normally over the last 10 years been loaning in the repo market for this collateral are realizing that collateral is not worth anything right now, and I'm not willing to lend out my dollar for such a low interest rate because it's not creditworthy. Well, September 16th came along, and when the repo market dried up, rates skyrocketed. And all that means is that there were people needing to borrow money short term, and there were not enough lenders to lend that money at such a low rate. And so the people who needed money said, well, if you're not going to loan me money at 2%, how about 3%? How about 4%? And it got all the way up to 10%, which is an insane spike in this market, until the Federal Reserve stepped in and said, whoa, this is crazy. We're just going to print new money and we're going to offer it to you at 2%. Now, they said this was an emergency measure, and they said it was only going to happen for a couple of days, and then they said it was going to happen for a couple of weeks, and then October, I can't remember the date in October, but someday in October came around and they said, we're going to be doing this until next year sometime. Every single night. And now they recently just announced that instead of it being $60 billion a day or $75 billion a day, it's now doubling and going up to $120 billion a day. So what this shows you right now is that number one, there's a massive amount of collateral in the system right now that is not good. Number two, the Federal Reserve still is doing the same thing they've always done that eventually leads to collapses, where they're saying, we're going to keep on doing more of the same and pushing on the string until it all collapses. And they're offering very cheap money at very low interest rates that's far below what the market is trying to set. Because the free market is saying, hey, this debt is not worth 2% as collateral, maybe it's worth 10% or more. And it's signaling that there is distrust or bad investments in the system. But the Federal Reserve is coming in and saying, nope, we're not going to listen. We're just going to print new money and hope that solves it. So in conclusion, we know that the shadow banking system is nothing scary. It's just made up of normal companies engaging in normal business behavior. The Federal Reserve and the government wants control. And so they've labeled them shadow banking so that eventually they might be able to pull them underneath the same regulations that banks are underneath so that they can try and control the entire system. But the one thing that we've seen time and time again is that every time the Federal Reserve tries to control the economy, eventually they just make it worse. So what can you do? Number one, like I mentioned in my last video on cash, I would be highly skeptical of any interest-bearing account, like a money market fund, because when the stock market starts to sell off and these small, uncredit-worthy companies start to go bankrupt, a lot of these loans are going to be defaulted on. And when a lot of these loans start to get defaulted on, you're going to have a spillover effect into the wider economy. And a lot of this interest that has been promised in these money market funds is not going to be there. And a lot of the asset value that is inside of these money market funds is not going to be there as well. And so you could see a lot of these money market funds either freeze up or even have to pay back less than $1. I would also be wary of investing in some of these mutual funds or ETFs that are highly leveraged, because these can be exposed to some of the same areas of the economy that are exposed to a lot higher risk. If you're considering changing your job soon, that might be a good opportunity to roll over a pension or a 401k into an account that you have more control over how it's invested, to make sure that the mutual funds or ETFs or money market funds that are inside your account are not exposed to some of these more dangerous vehicles. But again, the dangers that are inside the shadow banking system right now are not inherent in them being outside of regulation. They're inherent in the malinvestment that is being encouraged and almost required due to the extremely artificially low interest rate environment that we find ourselves in right now. And like we've seen start to happen in the repo market recently, when the market tries to take over and compensate for the bad investments in the system, the Federal Reserve is going to step in again and offer explicit and implicit bailouts and guarantees and try and further manipulate and artificially keep down interest rates to keep on kicking the can down the road as far as they can. I would also be skeptical of keeping too much money in any account right now, just because if we do have a big collapse like we did last time and the government and the Federal Reserve is not able to bail the system out, you could have big shutdowns of major banking institutions and major financial institutions and not be able to access your funds. Now, while I don't recommend keeping a lot of cash because I don't think the dollar is going to be worth it, it's probably better to keep cash than it is to keep it in an account where it's just virtual and can be wiped out in an instant. And at least you have something physical. For any savings account, you might want to consider owning physical gold or silver, other commodities, and even stocks, because while they might be exposed to a massive market correction, recession, stock market crash, at least you still have ownership in a company that long-term will still try and find ways to make profits. So I hope that clarifies things for you guys today. The shadow banking system itself is not something to be scared of. It's not something illegal. It's not something operating in the shadows. It's just financial institutions that are not banks. And the reason they have to engage in some of the more risky behaviors right now is directly a result of the Federal Reserve's manipulation of the economy. The real boogeyman in the system is the Fed and not what they call the shadow banking system. Hope you enjoyed the content. Hope you guys have a great weekend. Thanks for watching. If you liked it, please hit that like button, please hit that subscribe button, and share with somebody else that you think might enjoy it as well. Thank you so much. You guys have a great day.